Welcome to the daily analysis video. It is April 4th. Let's jump right into the yield curve inversion. That has been popular in the news. We've been hearing that term being thrown around frequently. The yield curve officially inverted today. When we say officially, the 10-year inverted with the 2-year. So that's probably the most common one that is watched by mainstream investors, retail investors, Wall Street investors as a whole. And the reason that it's so important is because typically when the yield curve inverts, it shows that A, there's something fundamentally broken in our economy and our financial system that you need to be aware of, and B, there's tremendous risk in the system. Typically bonds as a safe haven asset have been what people are running to. That's not what we've been witnessing. In order for bonds to not keep crashing, they're going to have this is going to significantly have to steepen. And when you're getting a higher yield and return on investment on the 2-year as opposed to the 10-year, it shows that the long and short end are literally flipping, and that's how you get the inversion, which, as you can see on this red line, we inverted below it, and we're having a small bounce, but nonetheless we did penetrate and complete the technical damage on the chart. So analyzing the past inversions, you had a housing crisis appear not too in the distant future. You had the dot-com bubble, the tech crash, also appear in the year 2000 when the yield curve inverted, and the recession of the early 90s occurred. So you can see that when you've had these major inversions, and also here you just briefly touched the inversion point but didn't invert, and then not too distant later you had the COVID crash. So you can see the last 1, 2, 3, 4 clear inversions, and even if we had to go back and analyze the fifth, it would tell you the same scenario, is that when this inverts, something down the road is going to be a catalyst for the economy, a market, an asset class, and it's never a good sign. Now, typically we do have several months of stable pressure before the real crisis occurs. These were flash crashes. You know, the dot-com, the housing, the COVID, they were real flash crashes, events. And who's to say we don't have something like that again? But typically we do have some sort of buffer period, a short buffer period where the markets don't completely bottom out. So typically when you see the steepening, so for instance this price action, we've now inverted, and how quickly are we going to curve back up and start to steepen? Because as the trend starts to steepen, that is typically when the markets break and fall. Just like you had in COVID here, this was the original point where you almost inverted, and then you had the steepening trend occur, and COVID then crashed the markets. So as soon as you start flipping back into positive territory and holding that, now you want to hold both areas for an extended period. Like the yield curve is clearly damaged, but if it stayed down negative for a longer period of time, it means whatever gyration in the market is going to occur, it's going to be a little more worse each week that it spends inverted. So really pay attention for that steepening curve. Now another chart that we can use, and this is where bond investors are really going to have kind of a lot of market data to decipher, because the markets are changing so quickly. But it is the biggest investment market in the world. So often the smart money, the long-term slow money is in that market, but this market is moving so quickly in regards to adjusting to economic policy and certain economic conditions that aren't proving to be favorable, such as high inflation. So watching this ratio is extremely important. So understanding when it starts to steepen, that's typically when the markets are rolling over in its worst bout of selling. And then when we look at the 10-year Treasury constant minus the 3-month Treasury, this chart, there's a high correlation that where price action is currently, we're in this long-term channel. This channel goes back all the way till the 80s. So until the channel is proven to be broken, you have to respect it. You have a small faint orange trend line there. It's faint because it's more of a minor support. The two purple or pink lines here are going to be your major resistance and major support. As you can see, going back to the previous cycles, major support, you bounce, major support, you briefly broke it, but then you had a tremendous rally out from the low, double bottom bounce there, and then another bounce here. So when you hit the top of this channel, so when the price action, or if the price action goes like that to the top of the channel, and you hit the top of that channel, typically what that means is that you've hit a bottom in the market. So when you price action of the 10 to 3 year, or the 10 to 3 month, my apologies, it shows that when you hit the top of this channel over the previous cycles, like you did here, like you did here, and like you did here, that's when generally the markets find a bottom after all the selling has taken place. So this is going to be a good barometer when the markets are in that fear, that complete, utter panic mode. There's blood in the streets. People don't know what to do. And you got to let the charts guide you. You got to put your emotion aside. Yes, it's going to be scary. Yes, there's probably going to be headline after headline after headline, bearish news, bearish news, bearish news, everyone's selling. But when you can use the charts and the correlations and the previous cycles, because I'm a firm believer, there's many different cycles, there's new technology, but the one thing that remains constant in every stock market or asset appreciation and depreciation cycle, there's two things that remain constant, and that is emotion. The fear and greed aspect of money flowing, buying, and money selling does not change. Human emotion does not change. There's peak fear and there's peak greed, and that's essentially what makes cycles so important and such a powerful tool to use to your technical analysis and advantage. So when this chart hits the top of this channel, we will most likely be buying equities with both hands. Obviously, we will be watching how the price action unfolds and what certain systemic risks are on the horizon. But the charts often tell a 1,000 words, and it truly puts into perspective where you should be buying, and it puts the emotion aside. Now, if we look at the inflation rate, here again, this long-term trend analysis using previous cycles is going to be very, very important, because we're entering territories here where the last 40 years for inflation we have not experienced. So imagine, an investment manager or hedge fund manager who's had 25 to 35 years in the markets. That's a tremendous amount of experience, more experience than I have, and I respect that. But if people aren't abreast with the history of previous cycles, then it's going to be very damaging to overall portfolio performance. And certainly it could affect your own personal wealth. So let's just look at this long-term cycle going back to the 1920s, over 100 years ago. So this is basically a 100-year trend line connecting a pivot high in the 20s with peak inflation, another pivot high in the 46, 47 era, another pivot high in the 80s, and finally we're approaching potentially another high. And why is inflation in a downtrend, but the dollars that we're printing more today are higher than previous eras? Well, for one simple reason, that we have been in a deflationary environment, with the sense that technology has been revolutionizing the need for producing. And that's why technology has been the main driver for causing deflationary periods. And one can argue that we're never going to hit a peak innovation, a peak thing, but this is tremendous growth over in innovation if you think about where we've come in terms of technology to today. So yes, it's been a huge deflationary driver, but now the money spigots have been opened, and previous cycles, that's what also happened before. The money spigots, in terms of quantitative easing, increasing the the M supplies of money across the board has been very, very dangerous game. And now it's one where we're going to have to see the Fed. They opened Pandora's box in the sense of releasing trillions of dollars into the system. Now the question is, how much credibility are we going to give them? How much credibility do they deserve? Will they prevent some sort of economic catastrophe, or are they going to cause one? There's a lot of speculation on both sides of the argument that A, the Fed is there's never a soft landing, and I agree with that point. There's never a soft landing. B, is the Fed tightening into a economic recession? Now, we don't really know, but often you're in a recession before you actually know you're in a recession because you have to relate on the 2 consecutive quarters of growth numbers. So often you're already 2 quarters deep before you can really say, technically, yes, we're in a recession. But a lot of the indicators on charts, and that's why I love charts, because it's real-time data. You don't have to wait for most of the government data to be released. It's very, very accurate in the sense as to how quickly you get it. So with inflation almost reaching this peak point where I do think that's where we're hitting the top of the tightening cycle, which is a couple months away. I do think that's when inflation starts to at least roll over. It's not saying that it's going to come crashing down. If there's a recession, it could put a tremendous damper on inflation, which is frankly what's needed. But nonetheless, I do think inflation will hit peak very soon and then start to decline slightly, finding support probably in the 4 to 6% range before consolidating for another move either up or down, depending on what the policy that the Fed does. If the Fed sticks to tightening for an above average time, let's say 2 to 3 years, then, which I don't think they will be able to, then inflation will come down. But if the Fed all of a sudden, in 2023, let's say we have, the last 2 quarters, we have this big crash in the stock market, and then they come out in 2023 saying that they're going to support the economy again with low interest rates, and at that point we could see a negative Fed fund rate, which I don't think they'll ever admit to at this point in time, but it's definitely in their mind. We've seen countries starting to go down that route, but negative rates, and we already have negative real rates adjusted for inflation, deep negative real rates. So portfolios have been really hit hard. The portfolio performance of what has worked for the last 40 years isn't working in this dynamic that we're experiencing today. But this 100-year trend line should act as resistance. I'm a firm believer in the technicals until proven otherwise. This is a weekly chart, so you would need to see some consistent closure. And keep in mind the inflation numbers are delayed about a month.